Hello and welcome back to my channel. For those of you who are new, my name is Randy4short or Randy4short. And in today's video, we are going to be going over student loan interest and capitalization, like the definitions, how it works, things like that. So these are the things that I'll be talking about. So if that interests you, then stay tuned. All right, so I'm going to hit you guys with a couple of definitions first so you can understand what I'm going to be saying throughout this video and you won't be all like confused. So the definitions that I'm going to go through is one, interest. Interest is basically the cost to borrow money. APR stands for annual percentage rate. You can also think of it as your annual interest rate. Federal student, one quick note, federal student loans typically use a fixed interest rate. So a fixed APR. Disbursements are basically funds that have been paid out. So once you get your financial aid letter and then you're awarded and everything like that, the student loans will pay out. They will pay the school first for all of your fees and tuitions and things like that. And anything left over, they will disperse to you in the form of a refund. So when the college kids go crazy for spring break, typically they just got their disbursement from their student loans. To accrue. Accrue means basically to accumulate or build up. In this specific case, we're talking about building up interest. Capitalization. Capitalization basically means interest that is added to your principal balance. So in this case, for capitalization, I'm talking about any unpaid principal balance. All right, so the next section, we're going to talk about interest specifically. So federal student loans typically use a simple daily interest formula, which charges daily interest on the unpaid principal balance only. Note that some private student loans charge compound daily interest. So that basically means that interest is charged on the principal, the unpaid principal balance, plus the interest that accrued in the previous day or days. So the interest on that and the balance on private student loans can add up very quickly, especially if you have a high interest rate. So when does interest start accruing? So it kind of depends on the type of loan you have. For example, unsubsidized loans start accruing interest once they are dispersed. Subsidized loans start accruing interest after your 6-month grace period. So next, let's talk about capitalization. So what happens when interest is capitalized? That basically means that you pay interest on interest, and the amount that you repay over the life of the loan will be higher. So in a nutshell, that's what it means. So when is interest capitalized? Once a loan enters repayment status, that will trigger your loans to be capitalized. When a forbearance or deferment period ends, your interest will be capitalized. So I wanted to reiterate from my previous video, if you haven't seen that video where I'm doing a student loan overview, then I'll go ahead and link it up in the cards. But in that video, I mentioned that for the COVID-19 forbearance, there is no interest being accumulated. Therefore, once the COVID-19 forbearance ends, no interest will be capitalized. But I wanted to warn those who were in a forbearance or deferment period before the COVID-19 forbearance happened to check with their loan servicer to make sure that once the COVID-19 forbearance ends, it doesn't trigger any interest that accrued in their forbearance or deferment period before the COVID-19 forbearance period, to make sure that that does not capitalize. So just go ahead and call your loan officer just to be sure. Now, how to avoid or minimize interest capitalization? A couple of things that I thought of was to You could pay off your student loan balances while you're in school, but everybody ain't got it like that. So you can actually pay the accrued interest every month by sending interest only payments. Just be sure to note on your check or, on your payments that the payment that you're sending is interest only, and they should understand what you're trying to do. So another way is for you to only borrow what you need. So you want to review your financial package and, well, for one, you want to figure out how much you need. So you want to go through, see what the cost of tuition is, see what housing is going to be, how much are you going to need for food, and just basically all of your expenses. Just do like a quick budget for your school year and figure out how much you need to borrow. So once you review your financial package, my suggestion would be to accept federal loans before private loans, and then accept subsidized loans before unsubsidized loans. So that would be like my suggestion. And then you want to pay more than your monthly minimums. So that way you have like an excess in your monthly payment amounts. And then another thing is you want to put your payments on auto pay, because when you do this, typically you'll get a 0.25% interest rate reduction once your loan goes into repayment status. So, so those are a couple ways that I thought of to avoid or minimize your interest to minimize the amount of interest being capitalized. So next, I wanted to go over a couple of examples. So I wanted to go over how interest accrues and show you like a couple of examples of capitalized loans. Okay, so to show you how how interest accrues on federal student loans, I came up with a mock loan example for us to go over. So in this mock loan, our principal is going to be $10,000. So, and it's going to be $10,000 per loan. So right now we're just talking about one loan, and it's $10,000. The APR is a fixed 4%. The loan is a direct unsubsidized federal loan. The billing cycle has 30 days, and you are on a standard repayment plan. So in order to calculate your simple interest, you want to divide your APR by 365 days. So once you do that, you will have your daily interest amount, and then you take that daily interest amount and multiply it by your outstanding principal balance. So that's how you can come up with your simple interest payment, but let's walk through it. So let me get my little paper so I don't lose my place. Okay, so that is the simple interest payment calculation right here, if you want to write it down and do it on your own loans. So again, for your daily interest rate, you want to divide the APR, in this case is 4%, and you divide it by 365 because that's the number of days in a year. So once you do that, your daily interest rate is 0.00011. And sorry if you can hear that car alarm in the video. I mean, my block has been going crazy with engines and car sounds all throughout the day today. But anyways, in order to find how much interest you are charged on a daily basis, what you want to do is take your newfound daily interest rate and multiply it by your principal balance. So our principal balance was $10,000. So 10,000 times 0.00011% is $1.10 a day. So you are being charged $1.10 per day that you have this loan outstanding, this $10,000 loan. So if you want to find out how much you're being charged a month, what you're going to do is take your daily what you're being charged daily, and you are going to multiply it by the number of days in your billing cycle. You should be able to look at your loan and see how many days is in your billing cycle. If it doesn't say, then go ahead and call your loan servicer. So if we have 30 days in our billing cycle and we're being charged $1.10 per day, that is $33 a month that we're being charged in order to borrow this $10,000 loan. So, and on a yearly basis, you're going to take that $33 a month and you're going to times it by 12 months in order to find out that you are being charged $396 per year that this $10,000 loan is outstanding and hasn't been repaid. So now that we have those numbers, let's go ahead and go into a few examples of a capitalized loan. So I came up with 4 different scenarios. So the first scenario right here is going to be, say a student, like someone paid all of their accrued interest while they were still in school. And once the loans came due, once they graduated and their 6-month grace period was over, they put their loans on auto pay. So since they put their loans on auto pay, their 4% APR has now dropped down to 3.75%. So they're paying less on their loans overall, and definitely their monthly payments will be less because they're being charged less interest. So let's put right here. So say they went to school for 4 years, and each year they took out $10,000 to pay for school. So $10,000 for 4 years means that they have a total of $40,000 upon graduating. Since they paid all of their interest, their total loan amount when it comes to graduating is going to be $40,000, and they're going to be paying that $40,000 back at a 3.75% interest rate, because like I said, they put their payments on auto pay, so they got a 0.25% reduction in their 4% original interest rate. So that is scenario number 1. So let's say scenario number 2 is the same $10,000 a year for 4 years that they borrowed while they were in school. But in this scenario, they did nothing while they were in school. They just partied it up and lived their life, or they just didn't know that, like, they didn't know, nor did they take any interest into figuring out what would happen to their loans once they were repaid or once they graduated. So their loans are not going to be put on auto pay once they graduate. So their loans are going to be paid back at 4% interest rate. So their freshman year, they took out $10,000. So to borrow that $10,000 at the end of their freshman year, they owed, because we already did this scenario of how much interest they would be charged every year if they borrowed $10,000 at 4%. So their yearly interest rate charge would be $396. So for borrowing $10,000 for their first year, they paid $396 for their freshman year. So sophomore year rolls around and they borrow another $10,000, but they still haven't paid on their $10,000 loan from their freshman year. So now their $10,000 that they borrowed in their freshman year is going on year 2 of non-repayment, non-payment towards interest or anything. So that's $396 times 2 that they're paying. And now that they have borrowed another $10,000 for their sophomore year, they are going to be paying another $396 on this loan, $10,000 loan that they borrowed for their for their sophomore year. So on and so forth for every single year. Their junior year, they take out another $10,000 loan. And for their senior year, they take out another $10,000 loan. We'll be getting tight down here. So each year they took out $10,000 So for their freshman year, the first $10,000 that they took out has now accrued interest for 4 years. So $396 that they're being charged each year for that loan, times 4 years, because they've had that loan for 4 years. The interest that they're being charged on that is at a 4% interest rate is $1,584. So that is the total for borrowing that first $10,000. But the second $10,000 that they borrowed in their sophomore year, they only had that loan for 3 years. So it's $396 times 3. So the total of borrowing that $10,000 is $1,188. So now in their junior year, that $10,000 that they borrowed now has accrued interest for 2 years. So that's $396 times 2 years that they've had it, which they've accrued $792 on top of that $10,000 that they borrowed in their junior year. So now in their senior year, they borrowed $10,000 and $396 have accrued since they took out that $10,000 in their senior year, because senior year they only had that $10,000 for 1 year. So basically, if you add all of these up, you can say that they were accruing interest for $396 10 times. So 4 years from your freshman year, 3 years for your sophomore year, 2 years for your junior year, and 1 year for your senior year. That's 10 times that they were charged $396. So when you add that up, that total is going to be $3,960. So once you add up that amount of interest and you throw it on top of the $40,000 that they borrowed because remember they borrowed $10,000 each year. So now that's $40,000 in principal and $3,960 in interest. So now their total upon graduating is going to be $43,960 that they have to pay back at a 4% interest rate. Okay, so let's go on to the next example. And in this example, this person, they got hip, they got smart. You know, they started watching a couple YouTube videos, or somebody sent them a video about student loans, hint, hint, and they started paying attention and educating themselves on student loan repayment and, you know, basically getting their financial education up. So they came into the game a little late, but they got their act together in their junior year and they started paying the interest that accrued. But, you know, they're still college students, so they don't make that much money. So they were only able to pay the accrued interest each year that they took out $10,000 because, again, same example, we're taking out $10,000 each year. So their principal balance is going to be $40,000 at the end of the year for each $10,000 that they took out every year for 4 years. So, but for their freshman year, again, they weren't able to, they didn't know that they could make payments on their student loans while in school. So they've had that $10,000 loan for 4 years. And we already calculated in the previous example that having that $10,000 loan for 4 years at 4% equals $1,584 worth of interest when they graduate. So for sophomore year, having taken out another $10,000 loan in their sophomore year, that $10,000 accrued interest for 3 years. So at the end of the 3 years, once they graduate, that $10,000 that they took out in their sophomore year accrued $1,188 worth of interest. So when they graduate, they go ahead and put their loans on auto pay. And again, if you put them on auto pay, you get a 0.25 reduction in your interest rate. So now this person that got smart later in college, their total balance owed is $42,772, which they are repaying at 3.75%. So their monthly repayment will be higher than the person that paid off all of their accrued interest while in school, but it will be lower than the person that did nothing while in school and just graduated, went through school, partied it up, whatever, and graduated without paying any interest whatsoever. So let's take it to another example. For this example, this is my life is a trip example. So basically this is like a follow-up of this person that did nothing. So once they graduated, if you recall, they originally took out $40,000, and since they did not pay any accrued interest while they were in school, the interest that accumulated was at $3,960. So once they graduated and triggered their repayment status, the unpaid interest was capitalized. So what that means is that $40,000 plus the $3,960 of unpaid interest now combines to make a new principal balance of $43,960, which they have to repay at 4%. So now they're out of college, they're trying to get a job, but the job market sucks, they're being underpaid. You guys already know the gist. Instead of going to get a job at McDonald's and paying like their accrued interest, they decide to put their loan on deferment because they're having a economic hardship and they're trying to find a job that, in their field that pays them what they deserve. But it's taking them a while to find it. So they didn't find a job until a year after they graduated. So they took a year, 12 months worth of deferring their payments. So with this example, we can't use these calculations anymore because their principal balance is no longer $10,000. Their new principal balance is $43,960. Okay, so I'm not going to write it out. I'm just going to tell you guys. So to find their daily interest, their interest rate is still 4%. So if you do the 4% divided by 365, they still have a 0.00011 daily interest rate. So if you take that 0.00011 percent and multiply it by this new principal balance of 43,960. Actually, I can do it on my calculator. Hold on. All right, so let's take 4% divided by 365 days in a year. All right, so I was so confused by my calculator. So basically, this is just showing me the decimal place moved 4 times to the right. So if I was to move the decimal point 4 times back to the left, it'll give me the percentage that I'm looking for. And I did round up. So let's just put in our percentage rate manually. So 0.00011 times our new principal balance of 43,960, which gives us 4.8356. So I'm going to round that up to 4.83, which is basically telling us the daily interest that we're being charged. So we're being charged $4.83. So on a monthly basis, if we still have a 30-day billing cycle, if you multiply 4.83 by 30, then that's $145 and let's say 7 cents if we round up, that we're being charged on a monthly basis while we're on deferment. So if we take a full year, 12 months of deferment, then that means $145.07 times 12 months means that we to put this loan, this new capitalized loan on deferment for a year, that means we've accrued interest of $1,740.82. Oh, so I didn't round up my decimal here. Well, actually, I'm just going to put it as 81 cents. So, yeah. Okay, so as you can see, with the deferment for this capitalized loan, it's way more expensive versus the $10,000 loan that we've been taking out every single year in college that only cost us $396 for that year. So that is the power of capitalization. So once you get that new job and the money starts rolling in, the new balance that you're going to be working on, because remember, once a deferment or forbearance period ends, any unpaid interest that has accrued will be capitalized, aka added onto your principal unpaid balance. So that means that now, once you have that new job, you are going to be working with $43,960 plus the interest that accrued during deferment of $1,740.81 in order to have a new unpaid principal balance of $45,700.81 that you will now be paying at 4%. So, yeah. So this is definitely the most expensive example that I put on here, because not only is your loan balance higher, you are still working with that 4% interest rate, which means that this scenario will have the highest monthly payments out of all 4 scenarios. So I hope that made sense. Please share this video with anyone that you think it may help. Hit that like button if you like the video, and please hit subscribe if it feels right, and I'll catch you guys in the next video. Bye.